Welcome to the weekly review of the markets from Hernandez Retirement Services. This is Agustin Hernandez. This week I will go over the charts of the S&P 500 index for the week ending January 4th, 2019. With all this volatility and positive returns, is the S&P back in bullish territory? Also, I will go looking at several indices that are trying to break out to an upside trend. And I end the video with, what does this mean? Before we begin the charts, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on an examination of past price movements and cannot predict the future. Technical charts reference are subjective. No strategy can ensure success or protect against loss. Investing involves risk, including loss of principal. The first chart I will be showing is a 4-month daily chart of the S&P 500 index. I am splitting this index into two different charts. The top chart will be of the daily price action of the S&P during this time frame. The bottom chart is of the S&P 2 moving averages during this period of time. The top chart of the S&P shows its most recent trend. Again, since we are using daily charts, the trends are short, but what we can gather is that the trend is down. Also, we have had two major downtrends compared to the rallies, which have been brief. So despite the recent rally, this index based only on price is struggling. Now the bottom chart, I keep price invisible so we can concentrate solely on its two main moving averages. In this week's chart, I will be using the 50-day moving average for the faster trend indicator. And I will again use the long-term line, the 200-day moving average. So as a recap, for a healthy uptrending market, we want the 50-day above the 200-day, and that the 200-day moving average line slow up. So based on this chart, what do we see? A death cross in December, which is negative. And the 200-day moving average looks to be beginning to slope down. So what we have here is confirmation of price action of the weakness of this index. So despite the recent rally over the last 2 weeks, there has been lots of damage done technically to this index. And it will need to work hard to get it fixed and moving back in a bullish trend. We follow that chart with the US 10-year Treasury note. Just in case you are wondering why the representation of the price of this index looks different from the S&P, is that price is quoted only at the end of business day. Now, our government's note price has been in a healthy uptrend since mid-November. It broke out of an old price range in mid-November and has not looked back. The key to its price action will be in its next true pullback. Will the price hold at its trend line? Will it have a new bottom, but at a higher price than before? The early part of new bullish trends is usually choppy as it tries to gather strength to prove it is worthy of a true long-term move up. Now, the bottom chart, we see the 50-day and the 200-day moving average for this asset. Now, unlike the S&P chart, here we see a golden cross in late December 2018. This is a good indication of this index gathering strength. Now, since this index has had a nice rally, I would like to see when the next pullback occurs if its moving averages can hold their respective places. And if it does hold, then we may be in for a longer-term bullish move for this index. The next index I go over is the MSCI Brazil Index. Now, this country's stock index at the moment is bucking the trend of the global equity markets. Let's look at the price-only chart. Price has been in a tight price range ever since it broke out to the upside in October. Here the index is taking a pause before its next move, either up or down. It has flirted twice with the top line, but failed. For a true upside breakout, we would need to have price break above this range. If this index can break above this tight price range, opening, closing above it for several days, then we can get a confirmation that a new uptrend for Brazil has begun. But we will need to wait and see, as these type of tight price ranges can last weeks up to several months. Now let's see what the moving averages tell us. And lo and behold, we had a golden cross, which is a positive in late November. Now, as price got stuck in that blue box range, we see that the 50-day moving average began to flatten out. Of course, it is a quicker moving average, so this type of action is not uncommon. But at the top far right of this chart, we may be seeing the 50-day begin to slope back up. That is positive. Now, the key for a long-term trend is the 200-day moving average. And what is it telling us? It is beginning to flatten out, which is great news, as it was sloping down for most of this chart. Can it complete the next phase and begin to slope up? We shall know in a couple of weeks. For now, there are early indications of a possible uptrending market. Now it just has to close the deal. The final index I will look over is the Gold Continuous Contract Index. Now, looking at the top chart, we see, similar to the US 10-year Treasury note, that this index has been in a nice short-term uptrend. Now, at some point, this short-term upward movement will end, and the key will be, can it hold its gains? Can it find support higher than we were when the rally began? We may know in several weeks. Now, unlike the US government note and Brazil, we see here that the 50-day moving average is still below its long-term moving average. The positive is that the 50-day moving average, it is sloping up. But since it is a quicker trend indicator, it can change direction before it completes a golden cross. Also, the 200-day moving average is still sloping down. So, on this moving average only chart, I would like to see the 50-day moving average above the 200-day, and that the long-term trend line begin to slope up. This is promising, but it has a lot more work to do than the US Treasury note and Brazil. What does this mean? The S&P 500 has had a good couple of weeks. It has with a short-term bounce off its lows. But real damage was done in this index that a 2-week rally can't fix. We have a downward trend in price, and its moving averages are not positioned in a bullish pattern. Now, I do expect more volatility over the next several weeks. Can this index begin to fight through turbulence and keep grinding higher? Or will earnings seasons disappoint and we see this index, which is in a weakened state, begin another drawdown? Patience for proof that the worst is over will be needed. The big story will be the US Treasury. As is the case when two uncorrelated assets begin to fight for supremacy, we see a volatile battle as the transition tries to begin. And what I mean by that is the US Treasury note benefited from the end of the year fall of the US equity markets. Yet, so far in these early days of 2019, despite the US stock market's rally, it has held on and been positive. At some point, there will be only one winner or bullish index between these two. Will it be the US Treasury 10-year note that has momentum behind it, or will the S&P and the rest of the US equity markets wake up from its slumber and claim top markets? As Football Hall of Famer Terrell Owens once said, get your popcorn ready. This will be an interesting battle between these two assets. Brazil shows us that we should never look at equity markets as one big asset. We should look at each market, asset, or sector on its own merits. For now, Brazil looks like an outlier. But don't fight the trend. For now, the home of beautiful football, soccer for you snobbish Americans, is trying to stand out like a peacock during this global slump. Finally, gold is trying to get into bullish territory. It still has a way to go, and it could just be teasing us. It has done well ever since the US dollar began to weaken. Will this trend continue? Like I said, it will take more work and grit to get through to get into a bullish pattern. So patience is the key here. There may be a true transition of long-term index leaders here, but we are still early enough that these short-term results can change. I would like to thank you for viewing this video, and I hope it was helpful. Please subscribe to my channel for future videos.